It's Brian Preston, the money guy.
All right, this one is from YouTube. The username is I didn't do it. That's
right.
really funny, first of all.
Okay.
Okay, the question is, I have enough cash to pay off my house. Great. Should I lump sum invest the cash or pay off my house and then dollar cost average the former mortgage payment into the market since the market is so high?
All right, so his question is, I've got enough cash to just write a check and pay it off, and it's in cash right now. Should I do that or should I invest?
Yes.
And this is a question that we get all the time, and I hate answering questions with questions, but there are some variables that we do not know. The first and most important of which I would say is your age. If you have enough money in cash right now to pay off your house, but you're someone that's in your 20s, 30s, even in your early 40s, I'm going to argue that the value of your army of dollar bills, the value of compounding interest, is so much stronger than the cost of a low interest mortgage right now. We know that interest rates right now are historic lows. While you could take that cash and you could just pay it off, pay off the house, and you wouldn't have to have that mortgage payment, there is an opportunity cost that even if you're someone who's 40 years old, by the time you get to 65, every dollar that you deploy into your army of dollar bills can turn over 7 times. Conversely, instead of that $1 turning into $7, if you retire mortgage debt, that $1 is going to save you 3 cents in interest. It's going to save you a very low percentage. Mathematically, we think it does not make sense to get crazy aggressive paying it off early. Now, the other question he says, I've got a lump sum in cash. How should I invest it now that the market is super high?
That's a good question too, yeah.
And I'm going to assume if it's enough cash to pay off the mortgage, it's probably a pretty substantial sum, certainly substantial relative to like your total net worth. We think that when it comes to putting large sums of money to work, frankly, whether the market's up or down, dollar cost averaging is your friend. We hear Dave say this all the time, that 80% of personal finance is behavioral. Well, investing is very, very similar. What you don't want to do is say, okay, you know what? I'm going to take this lump sum and I'm going to go invest it, and then all of a sudden COVID happens, right? All of a sudden fourth quarter 2018 happens. All of a sudden 2008 happens, and you start to become sick and, oh my goodness, what did I do? It's going to make it very hard for you to actually stay the course. So one of the ways that you can guarantee you won't be 100% wrong is by willing to not be 100% right in dollar cost averaging. And we think, Vanguard has done this study. If you have a big lump sum of cash that you're looking to ease into the markets, a course of about 10 to 12 months is usually the ideal time frame to get those dollars working. So I would answer, I didn't do it, your question by saying, I need to know how old you are.
Right.
And unless you're over 45, 50 years old, I don't know that I would be super, super excited about paying off that mortgage, because those dollars can be so much more powerful for you over the long term.
Yeah, you'll often come out on top net worth-wise just by doing the dollar cost averaging.
Absolutely.
When you're young. Love it.